Hello, this is Maurice Kempner, attorney, real estate broker, coach, and consultant, and welcome to True Legacy Wealth Media. So we're going to talk today about some of these rated returns that you see advertised on mutual funds or other investments and how this might be a little bit deceptive, and it takes a little bit more of a deep dive to figure out exactly what you're dealing with. And I'm not saying that the people who promote these things are being deliberately, I'm not saying they're being deliberately deceptive, but I'm just saying it's misleading the way this works. So let's say you have $100,000, okay, in this investment, whatever it is. And let's just say in the first year, the market, because of the market, the way it works, this investment goes down 50%. At the end of that first year, you're going to have a balance of $50,000, right? It goes down 50%. That's $50,000. You have $50,000 left. Now, let's say in year two, the market for this investment, whether it be a stock or whatever it is you've invested in, a mutual fund. So now let's say it goes up 50%. So we know at the end of the first year, you have $50,000 in your account. At the end of year two, the market goes up 50%. How much money are you going to have? Well, if you have $50,000 in your account and it goes up 50%, that's a $25,000 increase. You're going to have $75,000 balance in your account. It doesn't go back up to the original 100,000. Now, a lot of you already know this, but a lot of you don't. So this video is for those who don't know. It's a pretty important thing to understand. So now what's happening over this first 2 years that you had your investment is you started with 100,000. It went down 50%, the market did, and then it went up 50%. And so the average rate of return that the mutual fund or the promoters of the investment or whatever that they can advertise is a 0% rate of return. But really the rate of return for you, due to the timing of your investment, when you put it in and what happened over those 2 years, is a 25% loss, right? So let's say this mutual fund, let's say it's a mutual fund and it started out in a certain year. And 1 year it went down 50%, and the second year it went up 50%. They can go out and advertise, hey, we have a 0% rate of return. We got off to a slow start, whatever, 0%. But the investors who put into it originally are down 25%. And I'm sure they're not putting that in the advertisement anywhere, more than likely. So conclusion, that's just how this works. When you have a loss and then there's a gain, the percent of the gain has to be basically more than what the loss percentage was for you to regain all your money, right? This takes time for these things to happen and play out the way they need to. So just be aware of this concept when you're making investments. And when you look at rate of returns on things, whatever it is, it may not be what it seems to be.